Folks, you know the drill. This is not investment advice, just a couple of dudes discussing our favorite technologies in the Web3 space. Also, given our conviction, we have beneficial financial positions in these technologies as well. Hey, folks, welcome to episode 3. We have got, I think, a very exciting slate of topics to discuss with you guys. And Krishna is here to share a ton of knowledge with us too. Drop some alpha, Krishna.
Hi everyone, welcome to the episode 3. We look forward to sharing some of the tactical wisdom about uh, good savings rates that we are seeing in the markets with you and some live demonstration. So it becomes an easier way for you to take advantage of these rates.
Absolutely. And I am really excited about this episode because I think this is one of the first things that I've learned getting into the world of Web3 from Krishna around yield farming. Or basically, I was like, you know what? I got my treasury bonds, I got like 5% somewhere that's sitting. And, like a bunch of my savings was sitting in a bank account or CD with like 5% returns. And I thought that was it until I think Krishna introduced me to this amazing world that we discuss about today in terms of how you can maximize your return and while also minimizing, I guess, some of the risk that we see in the Web3 space. So without taking too much time there, let's jump right into it. So Krishna, where do you want to start? Do we want to start with the very simple, how we would, I guess, see most people tiptoe in, like that was how I tiptoed into the ecosystem as well. So maybe let's start with, the big players. Can you maybe explain the concept of USDC as opposed to USD, and then, why holding that is maybe useful or beneficial even for most people?
Absolutely, Sarat. I think that's a great segue. Uh, how about we actually take a step back and then look at the current state of what banks are offering? And maybe that's a great start for us to quickly get into the game of what we are dealing with,
Right.
and then also discuss what's the current Fed's funds rate
Mhm.
and what is the delta that we're missing right now.
Absolutely. Yeah.
Um, so, folks, as you can see, this is bankrate.com where you can. This is, I mean, utter sadness or travesty if you look at the current interest rates that these large banks are offering, whether Chase or Bank of America. While if you look at the Fed's funds rate on short-term treasuries, you the latest data shows you get 5.33% per annum. So you have a choice where you can buy literally the short-term treasuries from Fed and get a guaranteed return of 5.33%. Yet, in a capitalistic economy like ours, we still are dealing with a 0.1% interest rate. So this actually is a great starting point for us to look at the other options uh, where we can actually make more money on get some passive interest, and then we'll also discuss about different risk parameters that are involved in each of these options. So with that as our starting point, let's look at what crypto has to offer. And I'd say one of the go ahead, sir.
Maybe set the record straight there. Chase and Bank of America would offer a higher interest rate product, but that would probably involve you locking your funds for a certain amount of time. Is that a fair assessment?
Uh,
Because this
those
is just like a savings
Yes,
account, right?
yes.
What about CDs? Can you
Yeah.
click through the CDs and see what's up?
Oh,
See
yes.
on that.
With the CDs, it'll be a little higher, but I could not find Bank
Correct.
of
But
America or
no,
Chase.
I think the point I'm trying to make is with the
Yep,
CDs, you
yep.
get this like 6 month or 1 year term, right? You have locked in.
That's right.
You put your funds somewhere, they're locked there, and you get your interest. Whereas I think in the crypto world, what I found was that was you just made that interest for holding it. You didn't have to lock your money anywhere. I guess that's probably what I would probably love to hear.
No, that's a great call out. And also, there is also a minimum deposit if you see.
Oh
For
yeah.
all there is a term associated with it. On top of that, you have to. So, for example, if you're looking at Popular, the minimum deposit to get 5% APR is $10,000. That I think that's a great call out, Sarath, because even for Feds, if you want to get access to treasuries, short-term treasuries, uh, even that has like a minimum amount,
Right.
unless you are buying some treasuries, short-term treasuries exposure through stock market.
Yeah, that makes
Um,
sense.
yeah, so that's a great call out. Awesome. So with that, let's talk about the least risky one that we found. The least risky one, because A, it is offered by a large public institution, public listed company whose books are audited. And we are talking about, folks, something called as USDC. It is essentially a stable coin that is a coin that's been issued on these blockchains. We spoke about what the coins are on different layer ones in our previous recordings or previous sessions. So I would not go delve into those, but I'd
I'll link them
specifically
below so
keep it
you can easily catch up.
perfect. Perfect. Yeah. So the USDC is a trusted stable coin from Circle, and they are again a financial institution that's been audited by New York Fed, and they publish their reserves every quarter. So there is relatively high security, and they make sure that it is one-to-one backed by US dollars. So in the back end, they are actually holding a lot of treasuries, and that's how they're able to short-term treasuries. I have to clarify that because the long-dated treasuries yield is lower, so they hold a lot of significant amount of their portion of stable of their float in short-term treasuries, and that's where they are able to get the 5.33% interest that we've seen previously, and they are offering 5.2%. So Coinbase partnered with Circle, and if you open a Coinbase account and hold USDC, and USDC is $1. So there is no exchange fee, there is no additional fees involved. It is interchangeable, at least in Coinbase. So as long as you hold, I think this goes back to Sarat's point, there is no locking involved. If you hold for 1 day or if you hold for 10 days, you still get the interest rate.
You'll get the
So
equivalent
that is the
interest.
yes, yes, yes,
Gotcha.
yes. Sarath, is there how do you perceive risk, specifically risk associated with the Coinbase option of the USDC?
That's actually a great question. Normally, when you're holding money in a savings account, it's FDIC insured, so up to 250,000. You have the government backing that. Um, the way I look at it is this is government backed as well in many ways because the way the USDC is issued on the chain. When you follow the sequence of events like Krishna is mentioning is I'll make it really simple. If you buy $1 of USDC. Actually, it's not even buying. If you exchange $1 of USD for USDC, what's happening is this company called Circle, which is fully audited, buys $1 worth of treasuries, then issues you a USDC coin that you can use in any blockchain that supports this coin across with no fee. And the way they're giving you this interest is the Fed is giving them about 5.33% in interest, and you are getting 5.2% of it. That 0.13 difference is really what they're making in terms of fee. That's their motivation to sell you this, currency. And for us, we end up making that interest rate as long as you hold this token. And so you've exchanged your USD for a USDC, you can exchange it back for free as well at any point in time. Now, because it is backed fully by that federal treasury bill, it is in my head as good as being backed by the government. Now, whether these two institutions in between, Circle and Coinbase, can be trusted is you're always delegating, I think, some level of trust. And given these are all regulated institutions, I don't see them very differently as delegating my trust in a bank. And
Yep,
banks have been known to mess up, like credit unions have
yep,
gone under in the past. So I don't think anything is foolproof. But this is, I guess, a
right.
reasonable amount of trust in terms of they've met a
Yeah,
reasonable burden of proof for faith, to put our faith in them, I think.
yeah, that's actually a very good point. I think maybe uh, it is worth also talking about the business model. So if you look at a traditional bank, when you put your dollars in as a savings product in the bank is actually lending your dollars for a borrower. So there is a credit default risk that the bank is absorbing, which has led to multiple bank runs. Historically, if you look at 200 years of American history, 70% of the banks actually had bank runs. So this was actually a common phenomenon just 10 years, 100 years back before the Fed was created. And there, because of this business model, the FDIC insurance is really important. Now, if you're talking about Circle, all they do is they convert the US dollars into short-term treasuries. They make the money on the spread. And if you're not putting your US dollars, you're not holding US dollars on Coinbase, let's say you're holding your US dollars on chain, Circle doesn't even pay interest on that. So Circle makes money on the interest. So the business model is just holding the money. There is no borrowing component to it. So there is no credit default risk. So that is one of the nuance that I'd like to highlight. But again, even with all of this, I think you highlighted a really important point that there is some amount of trust in these institutions. Um, and these institutions are really large, and then they are regulated by US entities, and they are both US companies. One of them is even listed. So
Yeah, and for folks that follow the podcast, I'm a skeptic. So I want to say Circle does not have a lending entity yet, rather than does not have. Because it's usually a matter of time. All banks typically try to take that route, so we don't know their plans. But I would speculate that at some point in the future they might do a lending option. But right now, your money is as safe as it's in a bank, from my perspective. I would say my money, from my perspective, is as safe as if it's in a bank, and that's how I treat my USDC today. Maybe Krishna, let's so well, the easiest pivot here is saying, for me, this is as safe as having my money in a bank, so I do this part already. But the return, I think I can maximize a bit better, and that's where I've been trying to explore some of these on-chain options. Maybe Krishna, can you talk a little bit about like some of these on-chain options that we've explored in this past few weeks, months even, and how that's panning out?
sure. That's a great segue, Sarat. So let's talk about some of the lending and borrowing applications or dApps, decentralized applications. So the way these work is um, you deposit all the lenders deposit their funds into a pool, and the application with predefined criteria allows borrowers to borrow dollars against that. However, these are not like a typical banking loans that get approved without collateral. These are all collateralized loans. So if a borrower wants to borrow, let's say $100, they need to put some amount of collateral that's much greater than $100. And they might have Ethereum, they might have Solana, or they might have other crypto assets in their portfolio. They can use them to borrow different assets that they have from this lending pool.
Hmm.
So with that, I think it's a great point for us to quickly look at what are the dApps. I want to talk about again, there are different tranches of risk. I think lending and borrowing is the least risky of the ways to generate yield on your stable coins or your dollars. And the reason I say that is because most of these lending and borrowing protocols are all collateralized or asset-backed lending. So uh, these are not lent on goodwill, or these are not lent on some risk model. These are
Right.
all asset-backed. Okay, so I'll also show you how do we start. Like, how do we know? Hey, there are so many chains and so many L1s or layers, and how do we know which is the right application for me to identify which is a lending and borrowing application,
Hmm.
and how safe are they? Uh, so I did share about this in the previous video. Go back to the previous video just to understand the DeFi llama. But specifically for today, for this exercise, I'm going to start with Base. Base is a layer two. Layer two is a side chain, sorry, is a roll up that is on Ethereum. And this Base is again launched by Coinbase. Coinbase is running it. Base does not have a token currently. And the gas that you have on this chain is you use Ethereum as gas, basically. So when you come to DeFi Llama, you can go to Base, and here, when you scroll down, you can see a bunch of applications that are in the ecosystem. And across each application, you can see what category these applications are. Whenever you see DEXs, it means a decentralized exchange, essentially a way to swap your tokens. And then there is leveraged farming. We'll get into the leverage farming and DEXs in the subsequent videos. But for today's exercise, you can see there are a couple of lending protocols. Uh, and heads up that all of this list is populated based on how much value has been held in those applications. We call it total value locked. So you see that metric here. And you can see the two lending applications on this L2, this roll up alone is close to $160 million at this moment. And the best part about the blockchains is all of this data is public and real time. So at any point in time, you can clearly see without any permission entity what is the value on a particular application. So for your convenience, I've actually opened Aave. Aave is the decentralized lending and borrowing application on top of Base. This is how the interface looks like. You can see the different assets that you can actually lend and borrow. And then there are rates across both of them. So, for example, if you want to deposit Ethereum, you will be making 1.66%. If you're depositing USDC, you're making 5.27%. I got to remind you, these rates are floating, so these are not fixed. Unlike Treasury rate, these are not fixed. The Treasury rate is determined by Fed, and the short-term Treasury rate is determined by Fed, and they don't fluctuate on a daily basis. These literally fluctuate minute basis and hour basis, depending upon how volatile the market is. So these are free market rates. So it depends on how much a borrower is willing to pay. And right now, the floating rate is 5.27%. Typically, these are going to be higher than what Fed is going to give you. So for our exercise, let me quickly connect the wallet. So uh, just a quick tip or hack, Rabi is a great wallet if you want to use in Ethereum ecosystem. And this is how Rabi looks like. I
Krishna,
just connected my, yeah,
just a quick
go ahead,
question
Sir.
here. Because we see our users will definitely be able to see that we have both supply and borrow sides to this equation. So in the
Yep.
past, we've been saying, hey, in the other, like if you were depositing USDC to Coinbase or minting it from Circle, there isn't a borrow side of the equation, so the risk is very minimal.
Yeah.
Does that change here, or is this borrow uncorrelated to the deposit itself? Like what's happening here?
Yeah. Great question. So whenever we supply, that supplied US dollars or USDC in this case goes into a pool, and this pool, the other folks can borrow against this pool, and that is enforced through programs and deterministic logic. But a distinction that I told earlier is for someone to borrow against this pool, they need to have a collateral that is much higher than the borrowing value. So if the collateral value drops, the application programmatically sells those collateral and makes the borrowing whole, makes the asset whole. So that way, your downside is protected. So far, this application has been there almost close to 4 years,
Mhm.
and there hasn't been an incident of money lost. But again, um, we, these are still nascent, so we should always be caution. Don't put all of your savings into this protocol or any protocol for that matter. Uh, we still need to test them. The reason I say this is because if the market volatility is too high, where let's say Ethereum crashes 30% in a um, single wick, maybe
Mhm.
it happens in like 10 minutes or something. In that case, when even the application, when it tries to liquidate the Ethereum to make the dollars lent whole, there might not be a buyer, and a situation called as bad loans happen. These are typically contained, and then they're paid off from the fees that the protocol makes and the interest rate component that the borrowers make. So thus far it has not been an issue, but as more and more crypto assets become a thing for asset-backed lending, and if the volatility doesn't subdue, there is a real risk in that case.
That makes sense.
Okay, so let's see. I have seeded my wallet with like I think $100 of USDC just for this exercise. We go to the USDC pool. This is the pool that I was mentioning about. You can see there is $30 million. and there is $3 million for borrowing. And it says that the lending pool is almost 90% utilized as of now. And this is the current price of USDC because this is a stable coin. The price is typically close to $1. Okay. So it also shows what's in my wallet. That's $100, 100 USDC. I think I need to be very careful not addressing as dollars. It's a stable coin, folks. Okay. Yeah, on in the EVM land, you have to approve the first transaction. You're essentially allowing the application to um, do the. Uh, Sir, can we pause the video? So the first transaction, I have approved the application to use the US dollar coin from my wallet. And in the actual second transaction, I'll be supplying the US dollar coin, USDC, into the vault that we've spoken earlier. Okay, select the $100. Now I'm supplying it into the lending vault. Let's see. Okay.
Awesome.
Yeah. And one other thing I want to highlight here is because these are not um, there is not an individual or there is not a third party that is managing the pool. These are all programmatically managed. I think that is the key differentiation that the blockchains offer. All the logic of the application of the vaults and how the borrowing should happen, how the liquidation should happen, and how the lending should happen. All of these all the rules are actually written directly on the blockchain itself in smart contracts. As a result of which, every time someone repays their loans, they actually pay their loans back with the interest. And the amount in the pool keeps going up. So right now, today, the reserve size is to 29.38. My portion of that reserve size is, let's say, X. In 5 days, my portion, because of uh, my portion is going to be the same, but because the pool size is going to increase because of the lenders who might have paid the interest, uh, I'll get a larger portion that includes the interest component. So what that means is at any point in time, you actually are earning interest uh, at a minute basis, at an hour basis, or at a day basis, based on how many lenders actually pay back within the time frame. So that I think is a underappreciated nuance in the blockchains. So these are real time, and the interest accrues real time. Seth, based on everything that we've discussed on Aave, what's your take on the user friction or uh, take on potential risks looking at the whole wallet experience?
So I think the biggest gap I would say is the fact that, well, there isn't this explanation, right? Like if you didn't sit down here and make this video, nobody's going to look at the Aave website and understand that the nuance of, oh, this rate is floating, or oh, this rate is actually the rate I'm paying, not what I'm getting, because there's no difference. Like if you go back to that main dashboard, that's a list of rates. The supply APR and the borrow APR are both just like displayed the same way. How do I know one of them's paying, the other one's receiving? Right? I mean, it's
Yeah.
common sense, but otherwise, it's very hard to discern. And the other piece is like all of the nuances against which, like a bank, for example, would tell me whether if my borrow APY is going to go up or down. And I think that's the one thing I noticed here. If my supply APY goes up or down, I don't care so much. I'm getting more or less money. That's fine. But if I'm paying more or less money, that I think would be much more tricky. So I would love, for
Yep.
example, to be notified if my borrow API goes up. And I find it tricky to, I think, reliably get notified. If I'm not checking, no one's telling me. And if I'm not
Yeah.
learning, no one's telling me. So I think both of
Yeah.
those were a little bit harder.
Yeah.
until you came along and sort of walked me through this. And now, hopefully, some of our users are going to find this really useful as well when they're viewing this.
Yeah. Actually, that reminds me, I think there is a good point there to highlight, Sarat, because the borrowing rate, which is variable today, fluctuates a lot, and that's a real concern because that also impacts the liquidation thresholds. That also impacts how much you are supposed liable to pay. But I think as more and more people move into blockchain, as more funds move into blockchain, so this is a totally free market. Like these rates are free market. Once you have a lot of float and a lot of activity within on chain, then we should, then the volatility in the rates itself would significantly should come down. Then we should have much more predictable rates. In fact, the target state or the vision that I see if that world is going to materialize is they might be even more stable than what Fed is going to do because it is in Fed's control to raise or reduce rates. But in here, because it is free market, it might be even more stable than one particular entity making these decisions. So yeah, so let's see. I mean, we hope we get there. But also, I think one other subtle point that you mentioned is, hey, I'd like to get notifications, or I'd also want to make this interface much easier and simpler for me to make sense of it. So I think that is the next application that I want to talk about. And that is also one of the issue when someone actually looks at this. Hey, I see three lending protocols with $83 million, with $80 million, and then there is also the $60 million called Moonwell, right? Like, how would I know all of these names are completely new to me? How
Mhm.
does any of this make sense, or why would I pick one over the other?
That's
And
exactly it. Yeah.
also, yeah, and also, it so happens that the interest rates would be widely different across these. It depends on how many borrowers are at each place. So let's say there are more borrowers in Aave, the interest rates in Aave would be higher than let's say Morpho Blue. So there is a savior, and that component is called as a lending aggregator. So let's talk about lending aggregators, and specifically for this example, I've chosen Solana. So here, folks, I'll be switching from using Rabi to Solflare. Solflare is a wallet that I like. um, Google Soulflare, and then you'll be able to see the wallet. Uh, and Specifically, I like this protocol or this application because what this does is it looks at, hey, all these lending applications on Solana so that you don't have to worry about what are all the plethora of options. And the beautiful part is every hour it looks at the floating rate and it automatically readjusts the funds to the highest pool. So this is a great service for both the teams. It brings the demand and supply to the applications and evens out so that there is no significant arbitrage or delta across the applications. And it also solves on the user side, so you don't have to worry about every new lending and borrowing application that is popping up. So, and I think this is a phenomenal idea, and I've been using it for quite some time. So let me take a pause. Sarath, any questions on the
Yes,
aggregator
very
here?
quick
Yeah,
question. As we discussed, we are delegating trust in some of these institutions, right? So i-
yeah,
when we started off with something like Aave, there was a way for me to sort of vet it in DeFi Llama, sort of understand the pools there, and delegate some sort of gain confidence, I guess, to put some money in there, right?
yeah,
Experimentally
yeah,
speaking. Now, in something like Lulo, where we are handing money over, so this is something like a wealth advisor in my head. And
yeah.
I don't know where this wealth advisor is investing my money. Some of those places, like, does Lulo have any controls in terms of who is eligible to receive their funds? Are they, transparent about it? How does a user sort of get that confidence?
Yeah, great question. So this is kind of similar to how Aave works. So instead of you putting money into a lending vault, you put money into Lulo pool. So Lulo manages a pool. You send money into this pool. So let's say you send money, I send money. There are 10,000 other people who send money into this pool. Lulo constantly looks at different options and redeploys this pool of money through smart contracts into the different pools.
Oh, no, I guess I understand that, but we're adding an
Yeah, yeah.
additional layer of risk where
Yes,
in the
yes.
past it was Aave was taking my money, lending it to someone. Now
Yeah,
Lulo
yeah,
is taking my money, giving it to
yeah,
Camino or
yeah.
MarginFi, and they are lending it to someone.
That's right.
So rug pulls on their end could have a catastrophic effect on this end. Is that fair?
Uh, it is fair in the fact that the smart contract risk is doubled now because you have to deal with Lulo smart contract risk as well as Camino.
Hmm.
But it may not be the case where, okay, Camino is impacted. So there is a um, trickle effect onto Lulo because, like I told you, Lulo keeps constantly readjusting its pools to balance across multiple protocols. So at any point in time, your exposure, you're not 100% deployed in one application. Because let's say if Lulo is large enough, if they deploy all the vault into one, the interest rate rapidly falls down. So they kind of balance out across the different applications as well. So if you look at my activity,
Hmm.
so they have been rebalancing at, let's say, 611. They have deployed my funds from MarginFi to Camino. At 1:54 p.m., they moved from Camino to MarginFi. So they keep shuffling between these applications. So I wouldn't say that there is a snowball effect here, but there is double smart contract risk because you're actually dealing with this pool as well as the pool that these funds are actually going into. That's definitely there. So now let's quickly see how the experience of depositing same, let's say $100.
Hmm.
And you can see here, right now it says, hey, Camino is giving you the best option, so it's going to put it in that vault. And yeah, I think the real-time API right, that we are seeing right now is 10.22%. And I have deposited like $500 sometime back, and I've earned $15, and it's real time. You can see every second my interest is going up. How cool is that compared to what my Chase or Bank of America is offering?
That is
Okay,
awesome.
yeah, let's take a quick look at the data as well. I think this is one other interesting component that Lulu offers. So here we can see the different pools. What is the collateralization ratio? So this is the collateral that each pool
What other
mandates.
tokens do these guys offer other than USDC?
Oh yeah, most of the Solana tokens.
Oh, perfect.
So
That's great.
yeah, yeah, yeah. So there are a few things I wanted to highlight here. So here, every application, every protocol has their own collateralization ratio. So this is the asset-backed part that I was talking about. How much collateral you need to put. So let's say if someone wants to borrow $100, they need to put $174 in value of a collateral to take $100 from
Hmm.
the protocol. That's what this collateral ratio in this case means. And
Hmm.
you can see that is different across the board depending upon the quality of the collateral and how fast the application can liquidate the collateral. Both of them determine the amount of collateral that they need.
Got
So in this, yeah, yeah. And you can also see how much this pool has in total deposits, how much was borrowed in this deposit from this particular pool. And you can see the deposit and then borrow APRs. So like I was saying, so you can clearly see this pool, there are a lot more borrowers, as a result of which the borrowing interest rate is a lot higher.
it.
Um, okay, I think that's about it, folks. Maybe one other thing that we can quickly look at is if you have Solana and if you're looking to make some interest on Solana, there are also pools. Right now, you can make anywhere from close to 4.66%. That is close to the staking rate that these pools offer. So instead of holding Solana in your wallet, you can hold uh, any number of liquid staking protocols. Um, Sarath, how about doing a different session for those assets instead of rushing through them right now for this session?
Yeah, that makes a lot of sense. Let's maybe have a dedicated episode to talking about, things like liquid staking, some of
Yeah.
the other, Solana tokens that are here, and maybe even like jump over to another L1 we love, Sui, at some point
Oh yes. Oh
uh,
yes. Oh
on the
yes.
same topic, because I think similar unlocks exist across both, and maybe it's good for your users to know a little bit more about what's happening on other chains. All
Perfect.
right, folks, hope this was helpful. Thanks for listening in. If you have any questions, comments, feel free to throw them below. And as always, please like, share, and subscribe.
Like, share, and subscribe, folks. Thank you everyone for joining us today, and we look forward to doing a lot more of these.